This is Nicole Burns. A question that I receive frequently is, what is private mortgage insurance? And also called PMI. People hear PMI all the time and have no idea what it is. Going back a few years, during the mortgage crisis, a lot of people actually thought that insurance was going to protect them or save them or even pay their house off for them. And they were saying, Nicole, hey, I pay this insurance every month. Isn't it going to save my house? And it was really heartbreaking to have to inform them that no, that insurance is not for the borrower. It is actually for the lender. Let me help you out here. A lot of times, people will look for a loan that has the lowest down payment. And they look for these loans for different reasons. Sometimes just because they just want to put down the lowest down payment or because they need to put down the lowest down payment, especially in areas where home prices are the highest, like for instance, Los Angeles or some other areas, right? So here's the scenario. A home price is $300,000, and some loans may require you to put down as little as 3.5%, like an FHA loan, for instance. And there's absolutely nothing wrong with FHA loans. They actually create home ownership opportunities for a lot of people, and they are wonderful tools for people becoming homeowners, especially for the first time. They're actually excellent tools for home ownership. But sometimes it comes with a price, like PMI. And you get in for 3.5% down. You may have to pay some closing costs. Great. So 3.5% is $10,500. And a lot of times that's a doable amount. The bank, however, is giving a loan for $289,500. So you can see how the bank is taking on a lot more risk. And then if something goes wrong, it can be illness, or even something worse like death or a market crash like we had before. And the bank is exposed to a lot of risk. And the bank is thinking, hey, we've put in a lot more money than you have. And that borrower may just say, hey, I'm going to walk away from $10,000. So the bank may be a little more flexible, allowing you to put down the 3.5% instead of 10%, or maybe even more. And they may be more flexible on your credit. Instead of asking for that 700 FICO score, they may allow you to have 620 or 660 on your FICO score. With all that flexibility, it may come at a price. They may require you to carry private mortgage insurance to cover their risk. And in the event that you default on your mortgage, their risk, their money will be protected by the insurance, right? So if you foreclose on the home, you have no home, but their investment is paid for by the insurance. So you pay a little bit of money. That money is, it depends on the amount of the loan. The more the loan, the more the payment. And it's usually a few $100s a month. So you also have to take that into account. That money per month goes into your debt to credit ratio. So it can reduce the amount of home you can afford. My tip to you is talk to your mortgage loan originator. See if you need that type of loan. See if you need PMI. Maybe you do. Sometimes people are very surprised to find out that they don't. Go to NicoleBurns.com and read the blog about this to get all the details.